Alessandro is assistant professor of finance at Catholic University of Leuven. His research focuses on financial intermediation, financial regulation and financial stability, macroprudential policy, monetary policy, sustainable finance, and capital markets. So today, Alessandro will talk to us about a paper titled Bank Bond Holdings and Bail-in Regulatory Changes, Evidence from Euro Area Security Registers. Please, floor is yours.
Thank you very much, Olli. Thank you very much to the organizer for the opportunity to present this paper. Perhaps can you tell me when we have 5 minutes? Yeah, thank you. So the paper I'm going to present today is a joint empirical work with Carlo Ortavilla from DCB, Cecilia Melo Fernandez from the IMF, and Stephen Ongena from the University of Zurich. So the usual disclaimer apply, the views expressed are just ours and should not be attributed to the ECB and the IMF. So this paper contributes to the broader academic and policy debate which has been developing over the last few months, and particularly after the episodes of banking turmoil which took place in early 2023. But it also addresses one question which was already well present before. So what the adequacy and the effectiveness of the bank crisis management framework. And in the bank crisis management framework, which has been established after the global financial crisis, a key cornerstone is the bail-in tool for resolution. So the bail-in, if a bank is failing or likely to fail, allows to determine a write-off or a conversion into equity of debt claims. But in order to be able to implement the bail-in, banks should be able to have a large sufficient amount of bail-inable liabilities. So that's exactly the rationale behind the introduction of the requirements for bank bail-inable liabilities. In the EU, we have 2 types of requirements. On one hand, we have the MREL, the minimum requirement for eligible liabilities, which is applicable to all EU banks, and then the TLAC, which is the total loss absorbency capacity, which is specifically for global systemically important institutions, and therefore also for the EU ones. So the focus of this paper is to study the impact of the introduction of these requirements for bank bail-inable liabilities, MREL and TLAC, on the holdings of bank bonds by other banks. Why do we think that this is important? For 2 main reasons. So first, because regulation can foster intended incentives when it pursues the scope, but it might sometimes also create less intended incentives, or at least which were not partly within the scope of the initial regulatory provision. And second, because the bank's holdings of bank bonds may have potentially financial stability implications. In the euro area, we see that banks are the largest institutional investor sector in bank bonds, also with a strong own bias, particularly in some countries. And more generally, when you have these bond holdings by other banks, you have some linkages across banks. And these linkages may, to some extent, create some difficulties or some constraint to the resolvability of banks via bail-in. Because if a bank is subject to the bail-in, then other banks would be subject to the losses. On the other hand, we also have to say that it is important that banks have some stake in the holdings of bail-inable bonds, simply because banks are also the most informed investors about their own sectors. So to some extent, it also provides some sort of skin in the game for other type of investors. Let me now give a preview of the paper in one slide. Thanks. So we focus on the introduction of the MREL and TLAC, providing these regulatory changes, and which affect both issuance and holding incentives. We conduct a difference in difference analysis, focusing on the first announcement of these reforms to study the effects on holdings by banks. And we answer 2 main questions. The first question is whether and to what extent requirement for bank bail-inable liabilities may affect also the incentives of banks to hold these bail-inable bank bonds. And we conduct this analysis both on the extensive margin and on the intensive margin. On the extensive margin, we find that banks, after this requirement, increase the probability to hold the eligible bonds relative to non-eligible ones by around 0.9 percentage point for MREL and by around 1.5 percentage point for TLAC. Then we also investigate the intensive margin, so the holding amounts and the holding shares out of the total outstanding. And we find in both cases that the introduction of this requirement fosters also a relative increase in the volumes of these exposures, with the difference that the increase in TLAC, let's say the increase in holdings of TLAC eligible liability was actually stronger already quite immediately, but that's also because the GCI banks, the global important ones, started to issue these bail-inable bonds much earlier. And then we also investigate the potential driver of these cross holdings, looking at risk taking, and in particular, focusing also on the on-bias. And indeed, we do find evidence of on-bias, particularly for banks in formerly stressed countries. Now, this paper contributes to three main strands of literature. I will be very brief on that. The first is about the economic effects of regulation, intended and less intended. And here we contribute by highlighting some regulatory incentives which might come from the bail-in framework for the bank's investment portfolio decisions. The second important strand of literature is about the correlated behavior across banks, which might come, for instance, from strategic complementarities and the implication on systemic risk. And here we contribute by highlighting this correlated behavior, which might come from cross-holdings of bonds. And the third strand of literature is about the effects of the introduction of bail-in. Here we focus on the holding decision of individual banks to specific bail-inable securities. So for the data, we use a combination of security level confidential data sources. On one hand, the centralized securities database, which includes data about debt instruments starting from 2009, with the indication of the issuer, the issuance and the maturity date, the security type, the nominal amount. And we also complement with DCM analytics for information on subordination. And then the key cornerstone for our analysis is indeed the securities holdings database, particularly the one at the banking group level. We use quarterly data from 2013 Q4 for the 26 largest euro area banking groups, where we have information about the nominal amounts, who was the holder. So we know which bank was holding bonds issued by another bank in a given quarter. So before describing the details of the empirical analysis, I just wanted to highlight some stylized facts about the developments in the market for bank bonds in the euro area. So first of all, before these regulatory changes, the outstanding amount of debt securities issued by banks was substantially declining, I would say starting from 2012, mainly for market developments related also to indirect incentives, or if you want, disincentives coming from monetary policy, because at that point in time, first because of the LTROs and then the TLTROs, banks could largely use the central bank funding also at more favorable conditions. So we had in general a decline in the outstanding bonds of bank bonds. But then afterwards, the introduction of this requirement somehow contributed to invert this trend, although with some lag in time, because they set new incentive to issue unsecured bank bonds and in particular subordinated instruments. So the requirements we are talking about, I would just give some few other details. So the MREL is a Pillar 2 requirement, which means that it has to be set specifically for individual banks by the resolution authorities. And in fact, the Single Resolution Board has started to set binding requirements between 2017 and 2018. But for the date of the event, in order to avoid a potential anticipation effect, we look at the EU Commission delegated regulation, which was adopted in May 2016, and which defines the guidelines for computing the MREL requirement and also the shortfall. And that is important both for issuer banks to know how much they have to issue, and also to older banks to know more or less what issuance might come in the market. The second requirement is the TLAC, which is a Pillar 1 requirement, so embedded in the EU legislation following the revision of the capital requirement regulation. Here, importantly, eligible liabilities must be only subordinated instruments. For the announcement here, we look at the Basel standard on the regulatory treatment of the TLAC holdings, which was followed just a few weeks afterwards by the EU Commission proposal for the revision of the capital requirement regulation. Let me talk a bit about the empirical strategy. So we have a regulatory change, which shows the introduction of these two requirements, which creates two types of incentive. On one hand, banks have to issue these bail-inable liabilities to fulfill their requirements. On the other hand, there is also a change in the holding incentives, both across sectors. For instance, you have some sectors like all households, which decrease substantially their exposure to this type of bonds, and within the banking sector. So overall, our key hypothesis is that because of all these incentives, there was an increased scope for holdings of bank bonds by the banking sector. Now, in order to conduct the analysis, we have to disentangle two dimensions, so the issuance decision and the investment decisions. And for this reason, we use security holder level data. And we conduct our analysis also by introducing some fixed effect in order to control first for issuer time variant development, for instance, in the funding strategy via issuer quarter fixed effect. And also we saturate further the specification, also looking at all their quarter fixed effect in order to control for the investment strategy. And we developed the analysis on the extensive margin, so looking at the holding decision via a linear probability model, given also the number or fixed effect, and also on the intensive margin, estimating a Tobit model on the nominal amounts and shares, and on the holding shares. So in the key specifications, so we conduct a difference in difference analysis comparing the 2 quarters before the introduction and the 2 quarters after the requirements. We also have some robustness analysis where we also check the timing, if there was any anticipation effect, also to consider the potential persistence afterwards. The key the key dependent variable is holdings, which can be, in the case of the extensive margin, a dummy 1-0, if a bank holds a given security issued by another bank in a given quarter, or in the analysis on the intensive margin, the exposure, so the amount of the bond held by a given bank. And the key coefficient for us is beta 2, which is the interaction between eligible, so if a bond is eligible for MREL or TLAC, and post, so after the introduction of the requirement, so which measures the impact of this change on the probability or on the amount of holdings. We also further explore in a augmented specification where these holdings were by other banks or potentially within the same bank, because we also have some intragroup exposures, which could be, which might have to be taken into account. And let me go now to discuss the results. So I present the results first for the introduction of the MREL on the effects on bank bond holdings for extensive margin and intensive margin. On the extensive margin, so here we have, we saturate progressively with fixed effect in the first column using issuer fixed effect, then issuer quarter fixed effect, and in the third adding on top of the latter. And we look at the double interaction term between eligible and post, and we see that after the introduction of these requirements, there was an effect of fostering an increase, a relative increase to be precise, in the probability to hold eligible versus non-eligible bonds, in a context where basically banks were decreasing the holdings and the probability to hold non-eligible bonds, while actually they were increasing the probability to hold eligible bonds. So there was a shift in the portfolio composition towards bail-inable bonds and possibly also more riskier bonds in that sense, in terms of overall riskiness of the portfolio. Then we also conduct the analysis on the intensive margin, looking both at holding amounts and at holding shares. And in both cases, we do find indeed that the MREL introduction fostered again a relative increase in the volumes and also in the shares of eligible versus non-eligible bonds. Importantly here, we have to consider, particularly for MREL, that the issuance of MREL eligible instruments started quite after the requirement. So to some extent, the effects that we see is mostly a reshuffling of the outstanding amount of bonds, also across sectors. While some sectors, for instance, households, were somehow decreasing their exposures, and banks they were increasing their holdings. And here we also compute the marginal effects on the of the Tobit estimation. As I said before, the outstanding amounts were still declining, but when the requirements were introduced, we observed that while the holdings of non-eligible bonds was still decreasing, so here it's at a fraction. So in terms of percentage, this means that for non-eligible, they were still declining by more than around 20%. For the eligible ones, they were declining only by 3%. So this requirement, to some extent, helped to invert, and this effect becomes much more substantial also afterwards, but we wanted to focus on the quarters right after in order to avoid confounding effects. Now, the analysis on TLAC. Here we, as I mentioned before, we focus only on the instruments issued by global systemically important institutions, and we compare the holdings of eligible, which have to be subordinated, versus non-eligible securities always issued by GCIs. And here we do find that the TLAC introduction increases the probability of cross-holding. This is basically the double interaction term. An important thing that we observe here in the case of TLAC, which suggests that well-designed regulation works and can be effective, is that when we look at the triple interaction term, where we consider beyond the eligibility and the post, also the self-holdings, we do observe a relative decrease in the probability to hold eligible bonds within the same banking group. Why is this important? Because the Basel standard on the regulatory treatment of TLAC holdings, and this is also a provision which has been established also in the revision of the capital requirement regulation, includes a deduction rule, such that if a GCI has some exposure to TLAC eligible liabilities issued by other banks or issued by itself, then this is going to decrease the amount of his own TLAC eligible liabilities. So if you hold these TLAC eligible liabilities, it goes against your interest because you will have less eligible liabilities on your own. So it will be more difficult for you to fulfill the requirements. So there was this incentive, which was actually effective in this case, but which was determined only for the case of TLAC eligible holdings by GCIs, and not in all the other cases. We also conduct an analysis on the intensive margin, and we do find corresponding results. On the triple interaction term, here is still negative, but it's not as significant as before. Let me go now to the discussion about the potential drivers of these holdings. Thanks. So we just focus on the cross holdings, where one bank holds bonds issued by another bank, and we try to understand what could be the potential explanations. And one of these could be related to home bias. So banks tend to prefer having bonds issued by banks from the same country. And for this purpose, we define a dummy OM, which is equal to 1 if a bank holds a bond issued by a bank from the same country. And we also, as before, augment the baseline specification with a triple diff in order to consider this dimension. And what we do here is also we conduct the analysis for the overall sample, but here I show what we have for two separate samples of the formerly stressed countries, if you consider those countries which were subject before to macroeconomic and financial vulnerabilities after the sovereign debt crisis, and the non-stressed countries. And what we see is that the umbrella introduction fostered an increase in the holdings of eligible bonds. That's for the umbrella, and this increase can be stronger for the bonds issued by banks in the same country, but this holds only in the case of the bonds issued by banks in the stressed countries. So, which makes us a bit or reflect on what could be the driver. One driver could be you know better that bank because it's from the same country, so you know your own national banking sector. But if this were the case, this would hold for all. Or another reason could be an incentive related to a potential, let's say, too interconnected to fail paradigm, whereby there could be some strategic complementarities to hold reciprocally bonds, which might have the implication of reducing, let's say, the probability of bail-in, and in case of extreme necessity, potentially have a bailout. Of course, this is completely an extreme situation. So we do find this analysis, these results on the extensive margin. We also conduct the same analysis on the intensive margin, looking at the holding amounts. And also in this case, we find that this increase in the on bias after the introduction of the MREL requirement was particularly observable in the case of the bonds issued by banks in the stressed countries. We also conduct some robustness analysis, as I was mentioning before, both on the timing. So we also conduct a robustness analysis considering other potential hypothetical treatment dates before to see if there might be any anticipation effect, and we don't find that. Let me go to the conclusion. So the focus of this paper is to analyze the effects of the requirement for bank bail-inable debt on the holdings of euro area bank bonds, particularly by banks. And we do find that the introduction of the MREL requirement fostered a relative increase in cross holdings of bail-inable bank bonds, also by strengthening the on bias in the exposure to eligible bonds, particularly for bonds issued by banks in stressed countries, formerly stressed countries. And these effects are persistent over time and also robust to test for potential anticipation effect. Introduction of TLAC also have this effect of increasing the holdings of eligible subordinated bonds, and indeed shows, at least in the extensive margin, some evidence on the effectiveness of the deduction rule, which is a good news in this sense. So let me conclude with some policy implication for broadly for financial stability and regulatory design. On one hand, we see that some large holdings or an increase in holdings of bail-inable bonds may somehow foster these interlinkages, which might have potential financial stability implication. But on the other hand, well-designed regulatory framework, as for instance in the case of the deduction rule, might help in reducing these unintended incentives. Thank you very much.
Thank you very much, Alessandro. And the discussant will join us virtually. It's going to be Mr. Tiago Pinheiro from Banco de Portugal and CAS Business School.
Oh, hi everyone. Can you hear me and see my screen? Yeah. Okay, excellent. Well, thank you very much, Owen, and thank you for the organizers for the opportunity to participate in the workshop and to discuss this paper. Also, thank you to Alessandro for sending me the latest version of the paper, which was very helpful in preparing the discussion. So anything I'm going to be saying now, it doesn't necessarily reflect the views of Banco de Portugal or the Euro system. I'll start with the summary of the paper. Alessandro was very clear, so I don't really need to add anything here. The main question of the paper is about how credit institutions change their composition of their portfolios of bank bonds after two pieces of regulation. One is the minimum requirements on eligible liabilities, MREL, and the other one is the total loss absorption capacity. Now, the findings of the paper are similar. So they define that credit institutions increase the holdings of bank bonds that are eligible for MREL relative to the total holdings. And the same thing happens with TLAC. So credit institutions increase the holdings of TLAC eligible instruments relative to non-eligible ones. And then the paper has a number of different results regarding self-holdings and home buyers and whatnot. But in the interest of time, I'll skip that because Alessandro covered it. Now, onto my comments. I think the question of the paper is new. It's about the implications of regulation on bank liabilities other than regulation on capital. So most research focus on how capital requirements affect banks' assets, but this paper focus on how regulation on other liabilities other than just capital affect bank assets. Now, the answer to their question, I find it important, can be very important because it can be informative about who bears the bail-in risk that is associated with MREL eligible bonds. And so, if credit institutions are bearing this bail-in risk, then maybe that policy is increasing interconnectedness between banks. It's increasing systemic risk. It's also quite informative about potential liquidity issues if the banking sector is under stress, right? Whereby maybe these bonds or these bonds that are bail-inable are less liquid, and so if the entire banking sector is under stress, the issuer is under stress, and maybe the buyer, the holder, the credit institution that holds the bond won't be able to sell it. It may also be under stress and won't be able to use it as easily for liquidity purposes. I find the analysis to be well executed. The authors benefit from using granular data that allows them to answer a bunch of different questions and allows them to implement a different approach with a number of controls. So it's all of that is well done. Now, on to some of the issues that I've identified or that I thought could be relevant. Summarize my first issue as the results are about outcomes and not incentives. The paper's hypothesis and the interpretation of the results are very much written around incentives. So it's about credit institutions having more incentives to hold MREL eligible bonds after the regulation. Really, it may be the case that incentives, the policy, the regulation changed banks' incentives and changed everyone market participant incentives, but you don't really test incentives. What you test is the outcome, and so you may want to consider addressing that, because at the end of the day, the outcome, that's important because for the interpretation of results, at the end of the day, the outcome can actually arise not just it can arise because of different reasons, either the change in incentives of credit institutions. Okay. Now, this is an editorial remark. It's a very minor remark. Typically, I would leave it to the end, but because it's so pervasive in the paper, I put it first. And more importantly, it's kind of related to my other comments. So it's related to how you're going to interpret results. But my next comment is about whether the policies have an impact, or the impact of the policies that the paper is measuring, are they driven by an increase in the supply of these bonds or a change in the demand. So is it a supply or a demand effect? So the MREL increase led to banks issuing more bonds, and that's why credit institutions hold more of them? Or is it because credit institutions now have, are better, they have a competitive advantage in managing bail-in risk, and so they hold more of those? Now, the authors, I think that's the key question here, then, to understand what's driving the results. And I'm not entirely sure it's comprehensively addressed in the paper. The authors argue that using issuer quarter fixed effects controls for the supply effect. I would kind of disagree with that. I think that indeed you can control for the overall, by using issuer quarter fixed effects, you can control for the overall supply of bonds of a given issuer, but you don't control for changing the composition of that supply. And that's what's happening, after MREL, or that's what's happening. That's maybe what's happening after MREL, right? The issuers may be issuing a lot more eligible bonds that are bail-inable than before the regulation, and that cannot be. I don't think that's addressed or controlled for by using issuer quarter fixed effects. You don't really control for the composition. So what can one do? I don't have a silver bullet here. I have a couple of suggestions. One of them will be to control maybe for the shortfall of each issuer in MREL liabilities. Okay, and that I think that was known when the regulation was passed. So maybe you can control for that. That one is one way of controlling for the supply effect. The other one could be to control for the issuance of other liabilities that can also be used in bail-ins other than bonds, right? So issuers could meet the requirements by issuing other liabilities other than just bonds. And so maybe that's another option. Now, related to this, I wonder whether May 2016 is really the key policy date for the demand side effect of MREL. And I think that's, you're kind of trying to argue around that, but I'm not so sure. I know you test different dates, but I don't think you go as far back as June 2012. And I'm picking up on that date because that's the time of the Commission's proposal. And that the proposal is very clear about the type of liabilities, or at least seems to me very clear about the type of liabilities that could be used in a bail-in. And I think that those expectations, market expectations, were shaped around that time. So consistent with this view, I mean, we do see a sharp decline in the weight of total debt securities as in banks' main liabilities after June 2012. I know you have a different rationale for why that may happen, and that may all be true. But I wonder if the demand, if the market was already expecting some liabilities to become bail-inable and was sort of getting rid of them at the time. So maybe then the policy change in May 2016 is mostly a supply side shock, as banks become informed about their shortfalls in MREL. So maybe you can think about the May 2016 as a supply side shock, and then if you want to disentangle the demand side, maybe you go back to June 2012 or maybe a bit later, I don't know, and try to use that supply side effect and use it to decompose a total effect that could be happening earlier on. Okay, my last key comment I'll say is about policy changes that affect incentives to issue and hold different types of liabilities and not just bonds. Okay, so it's not, MREL is not just about bonds, it's also about other liabilities like preferred stock, for example, or just equity. So having this in mind is kind of critical to for inferences about the implication of results. And let me give you a quick example. One could start arguing that because banks hold or decrease less their holdings or increase the relative the share of bail-inable bonds that they have in their portfolios, that leads to an increase in the bank's interconnectedness or in the interconnectedness of the banking system. Well, that's not necessarily the case, because maybe at the same time banks are decreasing their holdings of other assets that are also subject to the regulation. Maybe they are decreasing they're selling their equity position on other banks. Right. At the same time, they are buying these bonds, and if that's the case, maybe the interconnectedness actually decrease rather than increase. And if the case, that then maybe the bank's risk or exposure to bank risk actually decrease rather than increase. Okay, so I think that's something to keep in mind, and I don't know if you can, bring on those other securities that could also be used to meet the regulation. I have done a bunch of minor comments. I mean, in the interest of time, I probably will skip most of them. Let me just point out that I think it's maybe a bit hard to generalize results to the banking sector when you observe 26 banking groups. I know that they represent a lot of the assets held by banks, but there's still only 26 banking groups in Europe. And more importantly, when you go and move on to the specifications where you saturate with fixed effects, and then we're looking at and you separate the samples across whether it's in a stressed country versus an unstressed country and so on and so forth, the number of data points of observations should reduce, right? And so then the representativeness of the results becomes, I would say, it seems a bit becomes a bit less. The results become a bit less representative of the banking system. Now, related to this, the number of observations in the data that in the results that you report in the tables and in the presentations, well, the number of observations stay constant across different specifications for each regression model. So you pick a table, you're doing the same type of regression, but with different covariates, and the number of specifications stays constant. The number of observations stays constant. I was a bit surprised. I was expecting, as you add issuer, quarter, and holder quarter fixed effects, I would expect some observations to drop. You wouldn't have enough. Some banks that are issuing bonds are only issuing one type of bond, maybe. So I was expecting those banks to drop. I was surprised to see the same. And related to this, there were some parameters that were really changing a lot. Actually, there wasn't parameters, sorry, specifically, that was changing significantly, the magnitude of that parameter, as you added the holder fixed effects and or the issuer quarter fixed effects. And so that, to me, suggests that there is something happening there with a number of observations as well. So something maybe to keep in mind. So I'll skip the rest of the minor comments. I'm happy to share the slides with Alessandro. Let me summarize. I think the question is important. The analysis is well executed, and the paper is well written. It was easy to read, and I was very happy to discuss it. I do have some misgivings about the current interpretation of results, but this is a small dent in my overall very positive impression of the paper. Thank you.
Thank you very much for this very comprehensive discussion. Let's open the floor for comments first here on the room. So we have a first comment here in the middle, please.
Yeah, thank you. Very, very interesting paper. I have one question, which is, I think, also related to what Tiago meant by that you are measuring outcomes and not the incentives. And I was wondering, what role could the interest rate environment have played to explain your observations? Because the last 10 years we have seen declining interest rates, and the consequence of this was that the hunt for yield was over time becoming more and more important. So you needed to get some positive yield, and in this sector it might be quite attractive because it was a sector where the sector got more and more stable. CET1 ratios were increasing, NPL ratios were going down, and then you have this new instrument which gives you a positive yield. And this simply was maybe a driver of your observations if you look also into this aspect. Thank you.
Good. And we have another question here from David. Oh.
That's very related because this incentive could also be maybe related to the capital requirement on those bonds. What is the risk weight on these things? Is it more? Do you get better return on regulatory capital on these bonds than you do on equity? And then a second question was, do we know whether the volume they hold is significant compared to the total outstanding volume, or is it smaller portions just held as part of the trading functions?
Very good. We have one question from the virtual audience, please, and then we move over back to Alessandro.
Thanks. Just one question from Professor Riem Yadi. So banks with the same business models tend to behave similarly in a crisis situation. They mimic each other and may adjust at the same time their liability structure. The expectation is at the system level, a diverse asking system in terms of business model is more resilient. So it's more a comment than a question. Thanks.
Very good. I have just one final remark myself on these intra-group effects, which I understand you included in your analysis, but you didn't elaborate very much about them. And the reason I'm asking about this is that I understand some colleagues in ECB and also here in EBA, we have looked into this issue and actually found that there is significant intra-group holdings of these MREL instruments in particular. So banks belonging to the same banking group are actually cross-holding these, and which probably explains part of your home bias results perhaps as well.
So thank you very much for, please. Sorry.
Oh, this is kind of a little bit more of a question about, a little bit more background. As far as the, the stressed countries, I was wondering, do the banks in those countries, do they generally have more kind of interbank lending or maybe co-book running for corporate bond issuances? Because maybe that's already, maybe that's not increasing, anything systemic if they're already interlinked in that way. So I was just wondering if that's something that you could expand on, just to, yeah.
Thank you very much Tiago, for the great discussion, for the very, very useful comments. Thanks a lot all for the very useful points. Maybe I might start shortly from some Tiago's point. Thanks for your point about, let's say, focusing on outcome versus incentives. So yes, perhaps, indeed, initially this analysis was indeed developed mostly at the extensive margin. So in such a way to understand more, let's say, what was going behind the, let's say, the decision to hold. But now we have introduced this part on the intensive margin. So in that sense, I fully appreciate indeed the suggestion from Tiago to focus a bit more on outcome, especially because actually we are talking about economic magnitude in terms of volume. So definitely that's also something that we can also readjust a bit in the draft. Regarding the question whether this effect is more driven by a supply dimension of MREL eligible bonds or an increase in demand. So there was indeed an increase in the supply because of this issuance. It's also true that this issuance started relatively late, particularly for MREL. For TLAC, they started pretty early because they had to fulfill the requirements by January 2019. But for MREL, they started pretty late. So at least for MREL, in the very first period, it was more a reshuffling of the composition of the existing investor base. I mean, households were decreasing their exposure dramatically, I would say, at least in some countries. I mean, for understandable reasons. And then regarding actually your suggestion about how we control for issuer time variant development. Yeah, thanks for your suggestion about looking at the composition of the new issuance. And the idea of using the shortfall of eligible liabilities can be definitely one idea. I mean, when I was at ECB, actually, we also ran a bit this exercise. So that's something we can definitely include into that. So thanks for this point. And regarding the timing of the event, so we could go a bit backwards in terms of data. But not before 2013 Q4. I mean, the data set for the securities holding starts in that date. So which means that perhaps we could consider the adoption of the BRD, which was, let's say, in the second quarter of 2014. For the, let's say, adoption of the Commission proposal in 2012, I mean, we wouldn't have the data to analyze that. At the same time, that was also, really much the period of let's say the start of the LTROs, but that's something we can think about. Thanks. And on the comments from the audience, thanks Klaus for your comments about the search for yield. I mean, we do conduct an analysis on the risk taking, which is mainly focused as of now on whether a bank invests in the bond issued by a lower rated bank. So it's more, let's say, a bank-to-bank analysis. But we could indeed also look more into, and indeed in that case, actually, we do not find significant evidence of a risk-taking behavior in that sense. But within the issuance of a given bank, we could also distinguish different bonds. And that's also important indeed. So I do agree with you, and perhaps also we could look at the other ratings which could be relevant also, for instance, thanks David for on the risk weight dimension. I mean, there are some papers looking at the search for yield using the risk weight as a bucket to see whether, let's say, investors, that's for instance, there are some papers on the EBA looking at whether investors were searching for yield within a given rating. That's something we can definitely think about. And the question about whether these volumes per se are significant. So on one hand, indeed, as I mentioned before, let's say some holdings by the banking sector are important as a sort of skin in the game mechanism, given that other investors outside of the banking sector should invest. But the volumes at the level of the overall banking sector are pretty high. Now in the presentation is around in the period we are considering around 30% in terms of institutional sector, much more than let's say insurance, pension companies, and so on, and it actually increased afterwards. So our analysis is indeed focused on 2016, but indeed, if you look at the data afterwards, especially in the last few years when the MREL issuance has been increasing a lot, then you see that banks were not holding any more secure debt, in other words, let's say covered bonds, while actually they were increasing quite substantially the holdings of eligible bonds in that sense. And on the comment from Reem, thanks on the comments about, let's say, banks having similar business model. That's another aspect we could potentially take into account in considering why a bank invests in the bonds issued by another bank. And from the thanks only for the point about the intragroup exposure. Yes, we do find quite some evidence about, let's say, self-holdings within the same banking group. In that case, we know the banking group. We do have potentially some information about the entity within the banking group, but it's not really a compulsory element of the information in the data. I mean, partly this can be considered positively if it can help, let's say, to bring the losses from the subsidiaries to the parent for a, let's say, one single point resolution entry. But it's also important to see whether this goes beyond. So thanks for your point on this. I think I covered most. Yeah, there was also one point about whether in stressed countries there might be more interbank lending or let's say some cross linkages. What we generally observe in stressed countries that, let's say, the market of these bonds is much more domestic per se. So to some extent, if it is more domestic, if you have less investors, even from other euro area countries, it is also more likely that banks have to step in that sense. But that's also something we can maybe further explore. I mean, that's also a period when, in any case, interbank borrowing was relatively low, and I would say probably even more in those countries, given, let's say, dimension of, let's say, credit counterparty risk. Thank you very much. Sorry if I took a bit.
Thanks a lot, Alessandro.